As you can see, I do have some markings on here from the past, just to let me know, what happened last time. There was a market crash, the reaction from it, the oil market crash. All right, what it looked like before and after. Some of that, this type of stuff is important to me when I'm doing some back testing and getting an understanding on what may happen in the future when it comes to different economic news releases or just world news releases, like the Russia situation going on right now with the Ukraine war, um, and how the U.S. I'm sorry, the EU uh, sanctions are going to be um, coming out here in the next couple of days, on the 5th, I think it is. Uh, that's going to be a huge thing. We do have OPEC news coming out next week. We have the U.S. oil reserves. That whole situation is going to play out later on this week as well. Actually on the 1st. So we expect to have some reactions in this market based on that. But what I'm doing is I'm going back and I'm looking at all of the reversals. All right. So I'm looking at all the reversals. So every time price gets to a certain point and it turns dramatically, I want to notate that. And what do I do with that information? I use that information to help me find other points on the chart where the price had a similar reaction. And I use that price range as a gauge on how I would move forward with the current price movement. So just off the top, if I'm looking at all the way back to 2006, you can see the market hit a peak here and it pulled back. That's significant, right? So what I do is I look at this significant pullback and I grab like a horizontal line and I'll mark it, right? And then I'll try to see if there was a point in time where price hit that area and had a big reaction again in more recent times. So as you can see, we go to 2011, you can see price hit this area, and now back here it was resistance. Price got to its peak, it resisted and it dropped. All right. Then it came to this area again, it got to this point and it turned and it went up. So that's support now. So once was resistance, now support. All right, boom. Comes back again, support. All right, comes back again, it breaks through. All right. Now we back to 2018. Gets into this price range again, rejects. So now it's back at a resistance again, right? Now it goes back up. All right, comes back down, breaks through, comes back up, and now it's at support. And this is where we're at again. So we're at the same price range where we had a big reaction in 2018, in 2012, 2011, 2006. All right, so very, very critical area where we're at right now. And, it's not that necessary for me to look at too many other points on the chart based on, where we're at right now. I really just wanted to look at where we're at right now in reference to where we were in the past and what price, what happened last time. You know what I'm saying? So as you can see, price is coming from a high, all right, up at 120, 128, dollar range. So I use that as well, mark that up and see if there's anything in the past that's similar. As you can see, 2008, it broke above that area and it dropped. That was right before it crashed, right? So it hit a peak in 2008, and then the stock market crashed and it dropped all the way down, right? So now we went back into this area again, all right? And a lot of people are talking about a crash could potentially be coming, a recession, all these different things happening in our economy right now could play a major role in what's going on. At this particular point, the stock market actually crashed at its peak, at the oil's peak, and then it dropped. Right now, it's already pulling back before they start talking about like a real crash or whatnot. So also, if you move it down a little bit, you can see that it was also a peak here before the 2014 oil crash. And it's not that far off. So if you look at the wicks and the bodies on these candles, the bodies actually stopped right where the bodies on the 2011 peak stopped. And then we went from 2011, consolidated all the way to 2014, and then it dropped. All right, so very significant areas here. So when I'm marking these up with the horizontal line, even though it gives you an exact price point, it doesn't necessarily mean that these exact price points are something that we should respond to. It's more so an area. So it's like a zone. So I use zones, levels, areas, all are the same. I might use a horizontal line but that doesn't mean that I'm using the exact price. I might just zone up this area right here just to highlight what's around it. So I might use something like this, where this is like a rectangle box, right? So I might take the rectangle box and then stretch it out across the horizontal line just to highlight that zone. All right. And as we go to a smaller time frame, you'll see that zone get bigger and bigger, and I just make it smaller and smaller based on how the candles are moving. So now we go down to the weekly chart, right? When we get down to the weekly chart, now we're looking at current time from 2018 all the way to now. As you can see, price reaction. All right, double top right here, broke through. All right, drop all the way down through COVID. All right, COVID drop, COVID crash, recovery, came back. 2021 July, hit this area again, pull back. All right, push through all the way up until November, October. Then it pulled back, came back down under it again, pushed through again. January 2022 this year. All right, hit a peak. All right, hit a peak in March. All right, springtime. Then it starts to pull back through April. All right, comes back up to the high again in June. And then from June, we're on a decline. So we've been on a decline since June. Double topped in June and started dropping. Now it's looking like a double bottom, same price range. All right, very, very significant area. All right, so now we go down to the daily chart. And as I, restructure the chart, double click it on the price access, and then I can get back to normal movements. All right, so now what are we looking at now? Very significant areas on the daily chart. We want to mark these up. Now you're going to have more markings up on the smaller time frames, because we're going to see these candles get a little bit more defined, and you get to see more wicks, you get to see more reactions. So you're going to end up marking the charts up a little bit more. All right, so now as we get down to the daily, very significant area here. You might not have more touches, right? So you got a couple touches here, breakthrough, a little bit of consolidation, price comes back, breaks through, breaks through, breaks through. So not really too many reactions off of this area after this. So I wouldn't call this a very significant level per se, based on the reaction that I'm getting in current times. All right, back here in 2021, it might have been a strong level, but here in 2022, not so much. As you can see, price not really respecting it that much. It's going right through it like it's not even there. Going right through it, going right through it. All right, so can't necessarily use this area as something to react off of, right? But what about this area? All right, so as you can see, if you look back, you can see price go over this area, come back up. All right, respect here on this November 16th, 2021, right? Bounced off of it, broke through. All right, respected a little bit, broke through, boom, it bounced here again at January 24th. All right, broke up, came right back, bounced off it again on the 7th and the 8th, bounced off it again on the 19th of September this year. All right, respected here, 28th. All right, came up, bounced off it again on October 19th and October 18th. All right, broke through, retested on the 18th of November, broke through, retested again on 22nd, retested again on 23rd, broke through. All right, so this is a very critical level right here. So I can highlight this. All right, highlight that. All right, and just looking at this price area right here. So now we go down to the 4-hour chart. All right, we go down to the 4-hour chart, and you can see where we're at. So now, boom. So why are these levels important? What am I going to do with this information? I'm basically trading off of these levels. All right, so as I mark these levels off, these are entries for me, and it's better to do it this way, because now, every trade that we get into, we're going to have a predetermined stop loss and a predetermined take profit. So when I'm trying to figure out how wide my stop loss is going to be, I'm looking at trading off of these levels, because it's easier for me to measure how wide my stop loss should be based on what the reaction is on price. So if I'm going to get in around this 81, 89 area here, I can use this as an opportunity to go long, place my long position here, and have my stop below support. All right, so below structure of this zone. That's another reason why I zone this up, like with this with this rectangle, highlighting tool that I'm using right now. Highlight this area. Sometimes I just use the width of these candles and the area that these candles are moving in to help me figure out how wide my stop should be on this particular move. And as long as you have a 2-to-1 risk-reward ratio or better, you're looking at a good trade opportunity. In this case, if I were to trade it all the way up to the high, right, that would have been a 11-to-1 risk-reward. So I'm basically risking 1 to make 11. I'm making 11 times my money. Every dollar that I'm looking to potentially lose, I'm multiplying that by 11. That's a very good trade. Very, very good trade. So that's the situation here. Now, obviously, you would need another horizontal line or area that price is responding to in order to have a good area that you want to take profit at. As you can see, you got rejection here, broke through, came down, reject, broke through, reject. All right, came through, reject. So this is a good, strong area. So if I were looking at the chart during this particular time, this would have been a very, very good trade opportunity to take. And I would have already had this horizontal ray or horizontal line on this. So I would have been expecting this type of reaction anyway. Even if you miss this one, okay, cool, you catch the next one. There's a bounce here, you catch that. All right, price broke through here. Maybe you try to go long on this one and you get stopped out. Price comes back, breaks through, comes back again. Now you go long again, boom, trade it all the way up to the top. All right, so it's not gonna be 100% as far as direction is concerned, but we get into some other things that help you figure out what direction you need to be trading in and shortly, right? So now, current time, right? 4-hour chart. This is like my baby. This is where I spend a lot of my time. 4-hour chart, right? So as you can see, I'm using the price, right? So I look at 1 or 2 touches. So I got one area where price rejected, price came back, and another area. All I need is 2. Once I get these 2 areas, I'll simply use one line and I'll drag it out to touch the next area, and then I'll move it all the way down to the future. So stretching it all the way out, now that's the trend. So as you can see, what direction is this trend line going? It's going down. So it's a downward trend, right? So every single one of these points where price goes down and comes back to test this trend line, I'm making note of that. All right, make a note of that. You can do a few different things. One, you can use the horizontal line and move it, all right, to see if there's anything in the past that can solidify this as a strong level. All right, so as you can see, you got a bounce here, breakthrough, right? So if you go back to see if price has respected this area, you don't need that much, but you just need, a little bit of evidence, right? A little bit of evidence. So you don't have to go back that far, but you can see price consolidated in this area. So it's a strong area. When you get consolidation, strong area, right? Price broke through, came back, tested it, bounced, broke through, consolidated again, strong area. When you get consolidation, it's basically a fight between buyers and sellers. They're going back and forth trying to figure out who's going to control the market from this particular price range. They fight. Finally, the bulls took over the bears and the price broke to the upside. All right, they fight. Finally, the sellers took over the buyers and it shot down to the downside. All right, so that's pretty much how that works. So now we get down to this price area right here, or this date range right here. Bounce. All right, this was a resistance. Price couldn't break through the trend line. It broke to the downside, dropped all the way down to this level. All right, now we at this level here. As you can see, price bounced off of it, broke through, came back, bounced off of it, consolidated. Bulls took over shortly. Sellers came back in, pushed it back down, came back up, dropped, shot through, bounced off of it. So this is where we are right now. So now, since we have this trend line right here, what are we looking for? We're looking for price to respect this trend line. If it respects this trend line, it will be resistance and it'll shoot back down again. All right. The only issue with this is if you're trading this from the trend line down, you don't have that much room to trade it to. I mean, you got 200 ticks, that could be a $2,000 trade. But, as far as the range is concerned, from this line to this line, I would be looking to try to trade it from support to resistance rather than try to catch it in the middle and shoot it down to support. All right, because it's a high possibility that price may not break through this level. Remember, we have a lot of economic and a lot of news coming out pertaining to the oil market. So it might not actually drop through here. It might be time for people to start looking to buy going into the wintertime. Oil is one of the markets that give you a lot of value. So people are going to normally look to buy oil during this particular time. So as you can see, support is very strong in this area. It's hard for price to drop through this area and stay down. All right, this is the farthest it dropped, and then it came right back up immediately. All right, we actually caught this low and traded this one. All right, this was last week, if I'm not mistaken. We caught this bounce from this low point, oversold RSI to the high. All right, so now where we at right now, I call this no man's land. It's in the middle of nowhere. What do I mean by that? I mean, it's not at a resistance level and it's not at a support level based on what I just looked at in previous price action. Now, if you want to go back and look at this point right here and use this as a point of reference, you can do that. All right, so you can say, okay, price respected this area and it respected it here. So boom, I put a line here and say price rejected, broke through, rejected, shot up, right? Broke through, came back, respected, shot down, respected, right? So you could mark that as a level. Right? But if you look at the bigger range that I have here, based on what I saw on a monthly and a weekly, this area right here, this whole entire area right here is very critical. So you're just looking for a level to trade off of. So as you can see, price is respecting this area right here, right? So it's a high possibility that you're going to get a reaction off of this price level, right? So you want to trade off of this price level. So how do I figure out what direction to trade in? Remember, it's a downward trend on this trend line. But another tool that we use is the RSI, Relative Strength Index, right? So if we blow this up, this is another indicator that we use to help us understand what direction we should be trading in based on the way these highs and lows are. So if it's up in this area, probably don't want to buy. That means it's overbought, right? If it's down in this area, probably don't want to sell. That means it's oversold. It's being sold too much. It's at an extreme level, it's probably going to pull back. So as we coming out of oversold territory, we're looking at these lows. So you see this low here and this low here. This low is higher than this low. Then you got this low. This low is higher than all three of these lows. So you can mark this up the same way you mark up the chart with price action. So that's an upward trend as far as support on this RSI. Now, if we compare this to what we see on the actual chart and look at the low here and the low here, this low is higher than this low, right? So we put that and mark that up on the chart. So now you have support, a support trend line. You got a resistance trend line up here and a support trend line right here. I got a lot of black lines, so let me change the color. Let's change that to blue so it stands out a little bit more. All right, boom. All right, so now you can see how the RSI and price action are not matching up. They're opposite, right? So you have a lower low on the price and a higher low on the RSI. We call that divergence. That's divergence. That's a very, very easy play to use or indicator or strategy to use to help you figure out what direction to be trading in, right? So as far as I'm concerned, the divergence is over. And this is how we caught the long position up here at support. This is one of the best long positions we've taken this month. All right, based on the RSI, based on price in a very extreme level, and then you go look at the news and everybody news says it hits a low since 2 years ago, 2020. You know what I mean, a 2020 low, whatever the case may be. You know, that's just adding to our technicals. The technicals always come before the fundamentals. We get into trades before the news even shouts it out. The news just gives us more confidence that we're doing the right thing. So now we're looking at this saying that, okay, clearly the divergence already happened. All right, once you spot it and there's a reaction, it's over. You can't really use it no more, right? I just wanted to point that out. So now it's dying down. So the bulls are getting weaker because the prices stopped. All right, so price stopped here at 1 o'clock today, and now that it's 10:30 at night, you can see it's been consolidating from 1 o'clock p.m. all the way to basically 10:30 p.m. No direction. All right, so we go down to a smaller time frame now. So now we get down to the 1 hour and take this off. Now we get down to the 1 hour. We're on a 1 hour chart now. As you can see, prices inside of the zone. All right, we got resistance here, we got support here. You want to trade off of these levels. So if you measure this, all right, I'm gonna use this so we can keep it on the chart. Boom, I'm gonna go from top to bottom, right? This is a 196 tick range. All right, so if you multiply this by 10, that's basically $1,960 per contract. If you want to trade this range, you can do that. All right, this is a trade opportunity. How do you play it out? So now that we're on the 1 hour chart, the RSI is even more convenient for day traders because now you can see that this will give you a signal. So once price gets over to the up into this range where it's overbought, what do you do when it gets overbought? You definitely don't want to be buying when it's overbought. You want to be looking for shorts. If you already have this zone marked off, you basically put sell limit orders on this price range. So every time price gets up in this area, you short it and drop it down, right? So let's just say, for instance, we look, maybe we didn't short it here, right? Because it just got into overbought territory and we saw the first rejection. But when it came back, we're ready for it. Boom. So we're gonna put the sell position tool on. Boom. Put the sell order on. Look how tight your stop loss can be. All right, we're talking about a 20 tick stop, maybe even tighter than that. Sometimes I like to go with like a 25. You know what I mean? That's a good number to look at based on reward, right? So if I'm looking at a range where it's 196 ticks, I want to make sure that my stop loss is about 1/5 or at least 1/3 of this. All right. If I can get something better than that, cool, even better, right? So in this case, we got I got an 8 to 1. So I was able to multiply the risk by 8 and trade it from the top all the way to the bottom, in and out. You feel me? And that's a good day trade right there. All right. So that's how you play that out. And that's why these levels are so important. All right. So you can use them on a bigger time frame with swing trading or a smaller time frame with day trading. By the time you get down to the 1 hour chart, you're probably looking at day trading these opportunities, especially when you measure it and it's only giving you 100 to 200 tick ranges. You know, a good volatile market can give you 200 ticks in one day for sure. All right, and obviously the tick range will change according to what instrument you looking at. But as far as oil is concerned, you know what I mean, that can happen in one day, absolutely. All right, so and then we can measure that just to make sure. So if we took a short here at 5 o'clock in the morning, which a lot of us probably wouldn't, probably 8 o'clock would be a better time frame, right? Short it all the way down to there. How long did that take? About 3 hours or less. From the top to the bottom, that's a nice day trade, easy $2,000 trade right there per lot. You know what I mean? I like to trade more than one lot, so obviously it would have been a bigger reward for me, but that's how you do that. So now we're going into tomorrow, right? We're looking at tomorrow's market. If we come to the market tomorrow and you see price up in this range, you got to decide if it's overbought on the 1 hour chart, you might be looking to actually short it, right? If you get up into this range and it's not overbought, and then you look at the tape, we like to look at the time and sales, we like to look at level 2, and you can see a confirmation with buyers coming in the market, buying it up, it's probably going to be a breakout. Now, one thing that I tell my traders is breakouts put you in very, very good situations because all the momentum is going one way, but those are not usually the best prices to get into a trade. All right, the reason why I say that is because price has to lead up to a breakout. So if we're going to trade this breakout, where did the price come from? If we trade in this breakout, the price came from down here. So technically, we're getting it at the worst price on the grand scheme of things. We want to come in down here if we can. You feel me? So by the time prices start breaking out, you're gonna get, breakout, retest, consolidation, people change their mind and short it and come all the way back down to support. It's not always the best price. Also, it's not always the best risk to reward ratio because the support is all the way down here. Now you're gonna get new support when price comes back to retest it, but you gotta wait for the retest. You feel what I'm saying? So you don't know for sure. So now, if you want to take this long, you got to be aware of where you want to be trading it to. Where we trading it to? We're going to trade it to the next level. Now you're looking at a 245 tick range to the upside, right? So when you get price to go out of here, you don't want to take the breakout. You want to wait for price to come down. And if price comes down, now you put your buy limit order on. Put your buy limit order on when price comes back. Get triggered for the buy. Trade it all the way up to the high where price stopped at before. Boom, that's a 245 tick range, which is about $2,500 trade. Depending on how many lots you do, 2 lots, that's $5,000 basically. You feel what I'm saying? So that's how we find our trade opportunities the simple way. There's a whole bunch of different strategies and different techniques, and I break down a lot of them. The traders that have been trading with me for the years, we got strategy after strategy after strategy in our bag, but one of the ones that is very, very promising, very, very easy. As you can see, I only got one indicator on my chart. That's RSI. It got nothing to do with price action per se. It's all based on the strength of the market and whether price is overbought or oversold. That's it. All right. It's not really helping me figure out what direction the price is going or anything like that. It's all about strength. Is it strong? Is it too overbought? Is people buying it too much? Or people selling it too much? That's all I really need to know. All right. And then when you start adding moving averages and all that other stuff, that also helps you figure out the direction of the market, the trend of the market, and gives you a minor support and resistance levels as well. We start looking at using the moving averages to help us with maybe entry triggers, maybe exit triggers when trailing stop, all that type of stuff. That's down the road. But right now, these are the most important things. Also, we also like to use volume. Volume is a very important indicator as well. So we use volume while we're in the trade to see, what the strength of the market is pertaining to buyers and sellers and who's in control and what kind of market we're dealing with as far as the shares or the contracts being exchanged at a rapid rate, right? So if you at a below average market, it's not really beneficial for you to be trading. Like right now, as you can see, the moving average on the volume indicator is up here, but the volume bars are way down here. That means the volume is way below average. This is not the type of market that I would be looking to get into a trade. You understand? So once price starts to get closer to these moving averages, which normally starts to happen as we start to get closer to like 3, 4 o'clock in the morning, working our way into pre-market time about 5, 6, 7, 8 o'clock, you're going to see those candlesticks or those bars start to go above the average line. And once you start getting above the average line, now we're dealing with high volume. Now we're dealing with more volatility. Now we're dealing with better movement, more momentum, and then easier pattern and trend recognition. And then that gives us to our targets and our entries a lot quicker. So, and then market manipulation is a little lower when you got more people that are active in the market as well. So that's there. I'm not going to go lower than the 1 hour chart because it's not necessary for this particular video, but just wanted to break down how we can go from high time frames to intraday 1 hour time frame to find trade opportunities. All right. So you can see how simple it can be for you to find patterns on any market. You can do this with any commodity, any index, any currency. Simply start from the monthly, find key important levels going all the way back from maybe even 10 years if you have to. As you get to lower time frames, find a little bit more tighter areas on smaller time frames that are relative to where the current price is at. I'm not going to go through the chart and mark up levels that are, $10, $15 away from where price is at right now, or $30 away from where price is at right now. It's not that important. I'm looking at the range, maybe like a $20 range between where price is at currently and where it came from, or where it might potentially go. Marking that area up, looking at the current looking at the current price and where the price is at this particular point, and trying to make sure that I find the levels that are most significant when it pertains to the date range from now, maybe a month or two in the past. All right, not too far. So by the time we get down to the 1 hour chart, you should be looking at a 1 month range basically, and using that information to your advantage. All right, so that's the oil market right there, and hopefully you guys were able to use this strategy and apply it to whatever market you're trading, and get some results from it. All right, thanks a lot. Peace.
For more updates, please like, comment, and subscribe to Courtside Trading Club.